Much for joining us this morning on this snowy morning in January. Congratulate you on making it here. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, the outlook on investing in infrastructure, was originally titled Planes, Trains, and Automobiles. However, with Mr. Obama's focus on stimulating the U.S. economy with infrastructure investments, our programming committee decided to expand the original concept into a more lengthy series, with today's session being the first installment. Today we'll hear from three very different practitioners. These speakers' views are their own, and they don't necessarily represent the views of the Roundtable members or its board. Frank Potel sends his sincere regrets to you. He unfortunately broke his collarbone and is recuperating from surgery, which he had last night. Fortunately, and this is not the order that they'll speak in, but fortunately our friends at CPE introduced us to Harry Toll. Harry is the co-founder of Alterna, a private equity firm based in Wilton, Connecticut that focuses on mobile infrastructure assets such as railroads, ships, and aircraft. Before Alterna, Harry co-founded the Core Capital Assets team within Citigroup that invested in mobile, industrial, and energy infrastructure assets. Sitting to Harry's right, Pierre Aury is the portfolio manager of the Clarkson Shipping Fund, a hedge fund based in London that focuses on shares of shipping companies and freight derivatives. The shipping fund is compounding at 13% since 2006 and has $190 million in assets under management. Before Clarkson, Mr. Aury was head of AEP and Enron's freight trading activities. He was also the head of shipping companies based in Istanbul, Sydney, Paris, as well as an officer on the merchant vessels of Louis Dreyfus. And sitting to Pierre's right, Stephen Girsky is president of Centerbridge Industrial Partners, a private equity firm based in New York City that focuses on automotive assets. Recently, Steve was named advisor to UAW President Ron Gettelfinger to help the union leader evaluate Detroit's Big Three current financial situation, including a potential GM-Chrysler merger. Before Centerbridge, Steve was special advisor to the CEO of General Motors, as well as a managing director of Morgan Stanley's automotive research team. Steve's also a director of the Dana Corporation. And the moderator of the Greenwich Roundtable today is Ryan Dartnell. Ryan's chief investment officer for a prominent New York family office. He's the author of today's session, as well as some of our more memorable symposiums. He's a trustee of the Roundtable and a member of our programming committee. Please welcome Ryan as he sets the table for today's discussion.
Thank you very much, Steve. We started thinking of the idea of a panel on planes, trains, and automobiles well over a year ago, named obviously after Steve Martin and John Candy's movie, but more motivated by some work we were doing. Part of the process we look at is sectors that have done poorly, companies and sectors that have done poorly over a protracted period of time, on the view that when capital leaves a sector, you get consolidation, you get tighter supply, fewer players, pricing power, and hopefully earnings. As we were thinking about the panel, we saw Kirk Kerkorian becoming an activist and a large shareholder in General Motors, and we also saw Alan Mulally being hired from Boeing to go and lead the restructuring at Ford, which was exciting news. At the same time, we saw big-name investors coming into the airlines on the consolidation play, and some also on the view that they would enjoy windfall profits as oil prices came down. And the context was Delta going into bankruptcy and then emerging in the middle of 2007. Then lastly, in the fourth quarter of 2007, we saw Warren Buffett buying into Union Pacific, Burlington Northern, Chris Hahn and other activists buying into CSX. With all that, we decided to postpone given the crisis, and I'm certainly glad we did. New auto sales, for example, in the last year have plummeted from a run rate of about 16 million new cars per year. We've gone down to an annualized rate in December of about 10 million. So really a poor landscape. For context, when Kirk Kerkorian was building his stake in GM, the share price was in the 30s. Today, the share price is under 4, and the long-term debt for GM is actually trading at about 18 cents on the dollar. CSX, Union Pacific, and the rail group shot up about over 50%, CSX being the main winner. Since then, they've all retraced those gains and then some. As you know, the airlines have continued to consolidate, but the stocks have been on a roller coaster. As an example, American Airlines started around 10, raced up to $40, and is now back at 10. And then lastly, in terms of consolidation, Delta and Northwest in September combined to make the largest airline in the world, largest passenger airline in the world. So interesting in that, in the sense of consolidation. Lastly, in view of the fact that Pierre is going to talk about shipping, I thought I'd mention the Baltic Dry Freight Index, which is an amazing graph unto itself. For many years under 2,000, and shot up over the period 2003 to 2007-8 to 12,000 for a six-fold return. It's now back down at 900, so half of the level it started at, and well over 90% off the peak to 1985 levels. After 9/11, we had airplanes stored in the Arizona desert. We had oil prices in the 20s and the economy flat on its back. After these huge returns we saw in these cyclical areas, we're way back down to where we started. So our original idea of consolidation is being accelerated by the economic downturn. The prices, as I mentioned, have crashed. I'm particularly happy to have our panelists here, as I say, after the crash versus before. I'm very happy to hand over to Steve Girsky, who's got a lot of experience in the auto industry, and he's going to bring us up to date with what he sees there. Thank you, Steve.
Steve, thank you. Thanks, everybody, for having me here today. What I thought I'd do in the next 10 minutes or so is basically do four things. Talk a little bit about my background, talk about recent events, what I've been working on lately, how this industry got to where it is, the problems we're in, and lay out a little roadmap where we go from here. And then I'm happy, after everybody speaks, to take any questions, and I'll hang around a little bit afterwards if you have any questions. As Ryan mentioned, or Steve mentioned, I was an analyst at Morgan Stanley covering the global auto industry for 20 years. I led a team. We had analysts on the ground in the U.S. and Europe and Japan, Korea, India, China. We covered suppliers. We covered dealers. We covered OEMs around the world. It was important because the car business is a global business. An action in one part of the world creates a reaction in another part of the world. There's also a lot of things that an action in one part of the value chain creates a reaction in other parts of the value chain. 20 years of being an analyst, that business started to change, wanted to do something else. Was on the phone with the CFO of General Motors in 2005 when they were going through their difficult times. The CFO, John Devine, at the time, was an old friend of mine. I'd known him since he ran an S&L for Ford. I said I was going to leave GM. I said, if you guys needed some help for a period of time, I'm happy to help. My wife gave me this hall pass to commute to Detroit for a year or so. Devine goes back and forth with Rick Wagner, who I had known since he was the CFO of Europe. And Wagner says, gee, Girsky's got perspective on dealers, on suppliers, on shareholders, on the union. Great to have him inside the company instead of outside if he could deal with a GM-type compensation system, which, needless to say, is very different than Wall Street. And it's frankly something that I think is wrong with Detroit. Yes, Rick, how do you get people to do what you want them to do? He says, people do what I tell them to do. I said, Rick, either that statement's wrong or we're telling them the wrong things because things are really not that good around here. I said, people do what you pay them to do, but you pay everybody the same thing, and, oh, by the way, the pay's not that good. Or people do what you tell them to do if there's a consequence for not doing it. And I said, when's anyone been moved out of here for non-performance anytime soon? Anyway, it was an amazing experience. I spent time with between 400 and 500 different people there. It was like your little rowboat pulls up to the super tanker, gives it a couple big kicks, it doesn't really move, and then it rows home. It's actually, I got a million stories about General Motors, most of which will never be told. But if you have any interest in things, it was amazing. I joke with people, not to get off, but I took a lot of pay in paper. So the stock was 40-something. I said, I figured if the stock goes up, it won't be all bad. Stock starts going down. I said, well, maybe it'll just be an expensive education. The stock starts going down even more. And it's like, well, maybe it'll be like a sabbatical. The stock starts going down even more. I'm like, well, maybe the movie rights will be worth something. Anyway, I left GM. I've been spending time with a company called Centerbridge Partners. I run the auto side of Centerbridge, which we have one investment. It's a $7 billion investment fund. It's part hedge fund, part distressed private equity. We've evaluated a number of significant auto-related investments. The one that that worked, that the deal worked, but whether the investment works, time will tell. We led Dana Corp's exit from bankruptcy. We partnered with the creditors and partnered with labor to bring an auto supplier out of bankruptcy at a time when a lot of other suppliers couldn't get out. And it really was about capital and labor working together to accomplish something other people couldn't. About 3 months ago, I got a phone call from Ron Gettelfinger, who is the head of the UAW. I've known Ron since he ran the Ford division of the UAW. At the time, Ford was going through turmoil. Management would always tell Wall Street what the union thought, and the management would always tell the union what Wall Street thought. So I decided to bypass the middleman and go right to the union, and we built a relationship. Ron calls me up. He says, Steve, GM and Chrysler approached us. They want to get together. They've been studying this deal for months. They basically want to announce it within a week. They want us to endorse the deal and agree to these 4 or 5 things. He says, we know a lot about how people move around. We know a lot about benefits and compensation. We really don't know a lot about M&A, how companies get put together. He says, will you come in as an advisor to us? He says, it won't take a lot of your time. He said, we'll pay you. I said, Ron, you don't need to pay me. We'll call it a favor between friends. Go under the tent. We sit down with Fritz Henderson, the CEO of GM. We sit down with Tom Lasorda, the co-president of Chrysler. We talk to their advisors. We ask a bunch of questions. I'm sitting at the kitchen table with my wife doing work the day before Election Day. I'll never forget this day. And I get the answer to some of my questions from GM. I open the slide deck up. I look at my wife and I said, remember this night. She says, why? I said, this is the night we figured out GM was going out of business. Go back to Solidarity House the next day, which is the union headquarters. It was Election Day. There was no one there. This was before GM had reported results, by the way. I go into to Ron. I said, Ron, you don't need to worry about a GM-Chrysler merger because it's not going to happen anytime soon. I said, you need to worry about something different. Namely, your largest constituency is going out of business, and I'm not sure they're going to make it to December. And I'll talk a little bit about that when we get going. I just want to talk to a few things here because it steamrolled from there. From that point on, instead of engaging GM and the advisors on this Hail Mary, we engaged them on, well, let's not engage around GM Chrysler, let's engage around Plan B, whatever Plan B is. And their response was, there is no Plan B. And you sit there and say, well, our math says you can't make it to December, and how could there be no Plan B? And needless to say, the situation got a lot more complicated from there. I have this presentation I'm going to pick a couple of slides off of, but I was on the phone with Ron and before the second congressional hearings on a Monday. I said, if you need any help convincing your guys the severity of the situation, I said, let me know. He says, really? I said, yeah. He says, good. What are you doing Wednesday? I said, what do you mean? He says, I got 500 people coming to Detroit, the head of every local union. Can you come present to them? Which was another amazing thing. He said, stay the whole time. You could see how we do things and what have you. He spoke. I spoke. Took 40 minutes of questions off the floor. They debated among themselves. With 500 people in the room, 5 people voted no on should we go engage, should we engage on restructuring or doing whatever we have to do. The point was, GM was in a rush to get a deal done. The results were poor. They were worried about investor reaction. And this so-called GM-Chrysler combination, they felt, had a better chance of getting government money. Again, we started asking questions about the upcoming results, and the entire tone of the discussion changed. When you think about how we got here, yes, there are a lot of internal issues with these companies that I don't need to go into about how they're managed and product portfolio and what have you. But basically, in the early part of last year, gasoline prices soared. It led to a significant mix shift away from high-profit trucks and SUVs towards low-margin cars. Commodity prices soared, pressuring raw material costs. Then you had this credit crisis on Wall Street that spread to Main Street. Dealers could not borrow money to fund inventory. Consumers could not borrow money to buy cars. GNAC, for example, typically has a greater than 50% penetration rate of cars, consumers buying cars through GM. In the last few months, it's been down below 5. GM can't get money. GNAC can't get money. Consumers can't get money. Consumers buy cars on credit. And that's one of the things that this crisis has exposed is just how much capital is tied up in this business. Needless to say, OEMs and suppliers couldn't borrow money to fund losses. The playing field has shifted dramatically towards companies with cash or access to it and companies with well-balanced product portfolios, companies that do well in cars and trucks as opposed to just trucks. Unfortunately, that doesn't exist in Detroit right now. This is not just a U.S. problem. One of the things everyone might say, well, it's union and management and union and management. It's not just union and management. The union can work for free, and it still wouldn't solve GM's problems. Okay? This is a problem that's going on everywhere in the world. Demand in Europe is evaporated. Demand in Latin America has come apart. I think last month there was one market in the world that was up in auto sales. It was China, and it was up marginally. If you think about how do you think about this? GM had $16.2 billion in cash at the end of the quarter, and people thought, well, 16.2, that's a lot of cash, but they pay their suppliers the second day of the month. So what they have on September 30 is very different than what they have on October 2nd. And then you look at that number, you roll forward at the cash burn, and you could see it was they probably weren't going to make it. In fact, they wouldn't have made it through January if they didn't get their government money. They were burning $1 billion a month in the first half of the year. As the credit crisis came through, they went to burning $2 billion a month. Let me just, I'll pass the baton in a second, but my opinion, where do we go from here? Everybody's going to have some very painful choices here. They need to put a plan together with credibility among all the stakeholders that's going to keep the company on the field in the near term and allow it to grow longer term. This is about every constituency going to have to come to the party. This business needs to contract, okay? We were selling 16 million units, now we're selling 11. The capital intensity of this business needs to go down. If you think about it, you got $80 billion of inventory on dealer lots. You got $800 billion of car loans outstanding. You got $50 billion of receivables to the suppliers out there. We need to shrink the number of cars on dealer lots. We need to basically, the car companies are not saying, I'm not saying people shouldn't buy cars on credit. It's the second biggest purchase after your home. But the concept of a cyclical company owning a credit company with the rating of the credit company attached to that cyclical company makes it very difficult to plan for the long term. That said, I think there's going to be opportunity. I've seen this before. I've never seen it this bad, but it's been bad in the early 80s. It's been bad in the early 90s. It was bad in the early 2000s. Demand stabilizes at some, albeit low level. Capacity adjusts. You get write-offs, closed plants, and then you get this extended period of recovery. We're selling at an 11 million unit rate, but the industry is scrapping 13 million units a year. So if you tell me society is going to change from 2-car households to 1 or 3-car households to 2, then maybe you could see normal trend demand coming down. But I don't think society is necessarily going to change. We may hold our cars a little longer, but typically what happens is in difficult economic times, people hold their cars longer. They start to wear out. I want to replace my car. I don't have the money to do it. And as soon as the money comes back, everybody heads to the car dealers to replace their cars. It's sort of like the harder you go down, the bigger the bounce. And I think that is the way it's going to work here. I was just at the auto show in Detroit. I have never seen such pessimism before, as opposed to last year at this time where there was a lot of optimism. So the good news is expectations are way down. With that, I will turn it over to, or how would you?
Sure. I think we'll move over, but let me just quickly ask a question. Given the distressed debt and private equity element, where's your brain on how to enter this market or how to take advantage of the opportunity and then probable timing?
So the industry is going to need capital to work its way out. It's going to need capital to facilitate consolidation. My guess is, and there has been private equity, but we've been part of it, getting involved here. But when no one knew that 16 million was going to become 11 million overnight, my guess is, in my view, is demand will stabilize probably around this 10 or 11 million. And once we get a few months, 3-4 months of this 10, 11 million, people will stop looking down and start looking up in the future. And listen, I don't know a lot about Forecasting car sales, I know one thing though. Anything we predict in the beginning of the year is unlikely to be the result. Okay, we are always wrong. Whether the trick for us as investors is, are we going to be wrong to the upside or to the downside? And I think the bias right now is everybody feels like they're going to be wrong to the downside. And remember, car sales at 11 million units, we haven't seen something this low since the early 80s, and the population of the U.S. is much larger than it was in the early 80s. So this is extremely unusual times. So my view is you get 2 or 3 months stable car demand, you'll start to get a lot of write-offs, and people will freak out over these write-offs or taking write-offs, most of which will be non-cash, by the way, and that will be the time to start to play more aggressively here.
Perfect. Thank you very much. Pierre, do you want to start?
Yeah, thank you very much. Very honored to be here this morning. One thing missing from Ryan's presentation on myself is the fact that I'm French. Nobody's perfect. Yeah, the joke still works. No, I'm saying that because, of course, English is not my native language. I tend to speak a bit fast, and sometimes together with my French accent, it's making things a bit difficult. So if you really suffer, just wave your hand, and I'll try to slow down. So I'm here to talk about shipping. It's got nothing to do with pirates with a parrot on the shoulder, a patch on the eye, a hook and a wooden leg. It's got nothing to do with oil spills. It's got to do with commercial transportation of goods at sea. So I'm going first to describe a little bit, in just 1 or 2 minutes, what the shipping market is made of, specification or specific attributes of the shipping market, which I think makes it an investable universe. And then we'll go to how to invest in shipping, a few words on what I am doing, no sales speech, so don't leave the room, and then a few words on risk and outlook. So first of all, it's a very, very, very old market. I mean, we can go back 2,000 years ago, and people were already shorting freight. They were committing to carry more amphoras than they had capacity to carry them. So I guess this is the first market which has been able to short. Thanks God the SEC was not there at the time. It's a very cyclical market. In the research department of Clarkson PLC, which is our mother company, they've gone back to 1742 compiling real freight data, and they've evidenced that it's always been very, very, very cyclical. I mean, Ryan mentioned the BDI going from 2,000 to 12,000 down to 900. Well, so what? It's always been like that. War, peace, feast, famine, empire building, empire destruction, changes of technology, sail, steam to diesel engine, it's always been cyclical. It's a very volatile. So the cyclicality is on a certain period of time. We're talking years, maybe sometime 1 year, 3 years, 5 years. If you look with a microscope, on a daily basis, which is the unfortunate fate of a hedge fund manager, basically it's as well extremely volatile. We are talking here about annualized spot volatility between 50 and 100%. So certainly not for the faint-hearted. It's got another attribute which is quite interesting. It's got low to very low correlation with everything else. Sometimes it appears to be correlated, but that's spurious. And I'm always giving the same example. If there is a war tomorrow with Iran, the Hormuz Strait most likely will be closed, which means that the oil price will go through the roof, and the freight rate for tankers will go down to zero. Okay, so it's usually very, very poorly correlated. So these are the main features. It's a very old established market. It's very cyclical, very volatile, poorly correlated with other markets. I can't demonstrate it here. I don't have the time. If we go more into details now, what is exactly shipping market? Actually, we are talking about shipping markets, plural. We've got the main shipping markets are the dry bulk markets. So dry bulk commodity, I can give some examples. It's iron ore, it's coal. I mean, coal is an interesting one because it's associated with the Industrial Revolution and little kids digging coal in mine shafts. Actually, coal is probably the fuel of the future, maybe not LNG. We have never carried as much coal as we carry today. U.S., for example, and probably you don't know it, U.S. imports coal from Venezuela, Colombia, Poland, South Africa, Indonesia. Okay? You produce a lot, you export a bit, but you import as well quite a lot. So that's the dry bulk market, which is a sub-segment of the shipping market. The tanker market, which I'm sure you're familiar with, Exxon Valdez and a few other things. The container shipping market, LNG market. You guys import quite a lot of LNG. LNG stands for liquefied natural gas. LPG, shipping market. LPG stands for liquefied petroleum gas. Chemical carriers, offshore shipping services. In the Gulf of Mexico, there is a huge offshore oil industry, which is serviced by fleets of very specialized vessels. So that's a sub-segment. Ro-ro, car carriers, reefers, and all sorts of things. So that's, from 30,000 feet a description of the shipping market. Now, that's all very nice, but, is that an investable universe? How can you invest in shipping? Well, historically, and this is quite interesting because a lot of the commercial law is coming from shipping, from, 300 or 400 years. So it's been one of the first investable universe in the world. Historically, hundreds of years ago, and you can still do it today, you could invest in shares directly into a ship. Okay? You can do that on your own. You've got some friends, you can invest in shares, abuse drawback, no liquidity. You're typically a minority shareholder, meaning that, probably it's worth less. But you can do that through banks. You can buy shares, of course, of shipping companies. Since a number of years, you've had a vast increase of the number of shipping companies listed. A lot of them are listed in North America, mainly New York, a few in Canada. Otherwise, typical places of choice for listing shipping companies would be Northern Europe, especially Scandinavia. Scandinavia, it's all about shipping, oil and fish farms, and Far East. You can, of course, do lending, straight lending. You can do mezzanine finance. More recently, you could, if you had the guts and the organization and the skills and the capital base, you could actually directly invest into freight derivatives. So they work pretty much the same as any other derivative market. The reference is indices published by the Baltic Exchange since May 1985, so that's quite old now, quite a long track record. They are simple CFDs, so basically I buy, you sell, and at maturity we compare the price with the index, and if it's higher, I'm the happy buyer, I collect money from you, and if it's lower, I pay you money out. We have options as well, and more importantly for you guys, investors, most of these products now are cleared. So you don't have to face the credit risk. People have realized that it's very well to talk about return on principle, but they'd rather talk about return of principle first, which of course is always a problem with the credit issues. Now that requires, of course, a bit of an in-house organization. I know some big hedge funds like Tudor, for example. I've got one guy who is quite knowledgeable in shipping, and on and off he does a bit of freight derivatives. Now you've got a new thing since a couple of years. You actually can invest in hedge funds which are specialized in shipping. The first one started about 8 years ago, and they used to commingle energy and shipping through shares of shipping companies and freight derivatives. And since May 2006, and we were the first one, you have now a bunch of purely specialized hedge funds, which do shipping only. Now, a word of caution. It's all about risk here. Okay. Provided you have well established your own risk profile. Okay, you've got a range. It's like a menu. You go to the restaurant, and the scope of shipping hedge funds that you have today, basically you've got at the top of the risk scale, you've got some shipping hedge funds which are doing physical ships. So they charter physical ships, and they hedge them with freight derivatives. And at the lower end of the scope, of the risk scale, you have got shipping hedge funds which are doing only shipping shares. Just the word of caution on the physical is obviously if you do a physical ship, you've got a lot of operational risk and you've got counterparty risk because, to my knowledge, there is no clearing for physical bills. Some people are working on it, but I don't see that happening anytime soon. Very, very briefly on our fund, we started in May 2006. As I've said, as Ryan said, we specialized in shipping. We do that through investing in shares of shipping companies and in freight derivatives, roughly 50-50. Our approach is basically on shares. We are a typical long-short hedge fund with a combination of a top-down and bottom-up approach. And on freight derivatives, we are really a directional player, and we make our decision based on a combination of fundamentals, which on the supply side is very easy for us because we've got access to Clarkson research. On the demand side, of course, it's as easy as modeling the world economy. We are back to the forecasting thing,
no problem.
which is quite difficult. We've got a team of 7. I'm heading the fund. I've got 2 PMs and 2 analysts and 1 CO and 1 assistant CO. We have got a very, very strong focus on risk, and I will give you 2 anecdotes which are very relevant to today's overall situation. Not that I knew what was going to happen, but as a joke, I always mention this anecdote when I was at sea in the middle of the North Atlantic on a small merchant vessel going into the Great Lakes, which I've done a number of times, outside the ice period. Basically, I receive a weather forecast, and it says it's all fine. And I go on the wing, and I see dark clouds, waves picking up, very strong wind. So I just put the weather forecast in the garbage bin, and I start to make the ship ready for the storm. So in July of 2007, I decided to start to split the cash of the fund. We are always very cash-rich because of the nature of the freight derivatives, which are cleared. So we put a margin, and we keep the cash for the difference so that we have no leverage. I started to split the cash of the fund between 15 banks. So, I was accused of being a little bit, what's the word in English, paranoid. I didn't know it would be that bad, but I knew something bad was coming. Hey, I've been working in Enron, so I know the mightiest can fall. I don't know and I've not learned how to cook the book, but I've learned how the books can be cooked. And I knew the banks were engaged into a serious book cooking exercise. So anyway, just the second thing is, last year, I decided to decrease the gross and the net exposure on the equity book. A, because I didn't understand what was going on. We had 25% of the 60 biggest or most volatile days since 1900 on the New York Stock Exchange. We had 25% of these 60 days in September, October, November. So that's scary. But I decided to scale down the gross and the net exposure on the equity book just because I was scared of Morgan Stanley, our prime broker, going bankrupt. I'm not picking on them because, that applies to all of them. I was in Enron. I'm still on the credit committee for Enron after 7 years, and I know how nasty it can be. So better at a very small portfolio being in the hands of the administrators. A few words on the outlook, where we are. As Ryan said, shipping market is down the toilet. So what? As a trader, the interesting thing from an opportunity point of view is the volatility is still the same. When the big vessels, the big shoeboxes with a propeller, carrying coal, were at $200,000 a day, or today, when they're at $10,000 a day, we have got the same volatility between 50 and 100% annualized. So from that point of view, nothing has changed. Of course, the biggest opportunity, which is one of the themes which is discussed today, is on the special opportunity front, which basically we've got ships which have lost 60, 70, 80% of their value, and therefore there would be a massive play on distress coming. I don't know what will be the timing. Actually, I've got an idea, but I won't share it with you right now. But that's going to be a big play going forward, and we are in the process of setting up a special opportunity fund for that. With that, I've finished.
Super, great. I think it makes sense to hand over to Harry. Harry's going to talk about shipping a little bit as well. Harry or Pierre, if you have questions for each other, I'd encourage you to ask them. Harry?
Well, I think we agree on so much that you may just hear an agreement fest going on up here. Let me distill down a little bit of what I just heard and tell that into what I'd like to talk to you about this morning. And it's going to sound a little different than maybe the starting point of this presentation, and that is I've been investing in what we call core capital assets. These are industrial infrastructure assets, very long-lived assets, very low technology risk, sort of beating heart, productive assets of the economy. I've been doing that for a very, very long period of time. I built a business at Citi doing it. It was pretty successful. And I think I can distill this all down to say one thing, and that is this is potentially the greatest investment opportunity that we'll see in the balance of my lifetime. What we have seen is an explosive repricing of asset valuation and risk. And for those who invest in long-lived assets that are not taking technology risk, assets that can produce cash from their operation, that are properly positioned and operated with counterparties that can continue to pay, this may be the greatest opportunity that I've seen in my lifetime. And I've seen some good ones. In fact, the business that I started at Citigroup from scratch in 1987, it looks to me like many of the people in the room may remember 1987. It was a picture that was not unlike the one that we see today. It was we're coming out of another period of very high inflation in the late 70s. In 1981, basically there was a dramatic increase in interest rates. Some will remember that the Fed funds rate, younger people would be shocked to hear the number, but got to 21%. What happened, of course, the economy started to react to that, and liquidity dried up, and all these capital industries, which had been flying incredibly high, repriced to a dramatic degree. Well, that is what has happened in the last 18 months. We saw this coming. I'll tell you a quick sidebar story. We were out talking to people in Europe, and we were talking to a major bank that had a $500 million investment portfolio in North American rail assets. They asked us what we knew. Some of the people there. They asked us what we thought they should do with it, and we told them they should sell it, and they should sell it now. And they asked us to help them do that, and I'm happy to report that we got that thing sold by the end of 2007, and they got out with a marginal gain. Let me also say, though, that since that time, in all of these capital industries, we're talking about energy, offshore, shipping, various kinds of industrial production, there has been this incredible shift. And that shift has taken us from what was basically an unsustainable position on the high side to something that is probably going to be a relatively short-lived position on the low side. So if from our perspective, deploying capital in the sort of strategy approach that we've historically taken, we are entering a period now of tremendous opportunity. I will also say that not only is that a long-haul economic opportunity, but it also may represent a hedge to another risk that's coming down the pike. And we believe that in looking at the monetary aggregate picture for the United States, that the inflation currently everybody's very focused on the rearview mirror of deflation, perhaps appropriately so. But for those who have a little bit longer view and who have real capital at stake, you got to be looking out of the windshield. And the windshield is telling us that there is rapidly increasing risk of inflation down the pike on dollar-based assets. So, there are lots of ways that you can hedge that risk away. One of them, in our view, is to own long-lived assets that have productive capacity that are not subject to technology risk. So, quick background on me, just a quick intro. I'm actually an engineer by background, as is Pierre. And I got into the finance industry almost by accident for another institution prior to Citi. I was sort of their industry analyst and asset manager for all these capital industries like shipping and rail and some other things. I ended up going to Citigroup where they let me start a business, and from scratch we built it to about $2.4 billion of Citi's proprietary equity invested. We controlled about $7 billion in assets. That business started in 1987. It was built off a very specifically defined strategy. And it was, as I said, it was a pretty good show. If you translate our performance into cash terms, it was about a 26% IRR consistently for about 18 years. And that doesn't even include all the embedded value that we could build into the portfolio. So it was a very successful business. But there are times when you can't deploy capital in our sector. Those times are defined by our strategy as places when you can't invest when prices are high and hedge that risk away with certain types of credit and other operating types of solutions. We saw that across the board in 2006 and 2007. We see exactly the opposite now. We see very low pricing. We still see the ability to generate solid cash flow for enough time, long enough periods of time that we think we can get a big part of our initial capital investment back at the same time that this economy starts to reestablish itself and get its footing, and then you're really well positioned. So we're pretty excited about this. We can talk more about, let me talk a little bit more about the spaces themselves. At Citigroup, we owned about 25,000 rail cars and 600 locomotives. We owned 5 LNG tankers, you name it. We owned one of U.S. Steel's half of one of their principal production facilities. A broad, diverse base of very important core beating heart revenue-producing assets. What we did not own were things like supercomputers and real estate. There are ways to make money in technology. There are ways to make money in real estate. That's not who we are. But we also owned, through various kinds of structured deals, some other international assets. We owned an undivided interest in 25% of a transmission system in Europe. So lots of different kinds of assets. And if you build a portfolio that does that has that sort of diversification by industry and geography, and you invest it based on a combination of asset valuation and longer cash flows, you can produce some really high returns. Proof of the pudding, if Pierre was mentioning before, they're publicly traded shipping companies. It's an interesting exercise. You just go onto your Charles Schwab account or your Bloomberg and do a little bit of analysis, and you'll see that there are some publicly traded shipping companies with decent contract underpinnings and excellent assets, good management that are currently producing cash yields on dividend. Forget about their general cash generation. I'll tell you that in a second. But their dividends alone are producing above 26%. In fact, some of them are producing way above 26%. If you look at their cash generation, if you owned those companies and could sweep all the cash out on the basis of the contracts they have and the counterparties they have, you could basically get about 90% of your capital back in 2.5 to 3 years. Those kinds of investments don't grow on trees. They grow on cycles. And the way to invest in these industries is to invest embracing the reality that these industries are cyclical. How do you embrace it? Well, you have to do one of two things. You either, and some paradigm in between, and that is when things are really cheap, then you are basically a distressed investor. In our case, we're a physical distressed investor. We're looking to get operating agreements around these kinds of assets. We have to be able to manage that process, and we have for the last 20 years in various sectors. But when things are strong, and there are ways to invest when market prices are strong, you have to hedge away that cyclical risk. How do you do it? You can only do it with very long operating agreements for these assets with very strong creditworthy counterparties, major oil companies, some of the biggest of the resource development companies, people like that. So it is possible to invest throughout these industry cycles. Let me spend 1 second on the issue of cyclicality, just so you can get our feel of why it occurs in our sectors. It's not just driven by the fact that the global economy rises and falls or national economies rise and fall. Certainly those things are inputs to what we have to deal with. But that's usually what's driving the demand side for these assets. What really makes shipping and what really makes plastic production and other sorts of industries very cyclical, at least our view of it, is that if you take a scenario where we have basically balanced supply and demand starts to rise, as we saw with the BRIC economies, what happens? Well, of course, many of these industries, shipping is a perfect example, are quite efficient. Pricing is immediately reported. Rates start to rise. You can see that happening. But you cannot add supply quickly. That's the principal driver as to why these industries become cyclical. Because as demand starts to rise, and that's obviously calling for more supply, you cannot add supply. There's a delay to build a ship. There's a delay to build more steel capacity. There's a delay. So it's that delay that allows the efficient markets to continue to price rates higher until that demand starts to get delivered. The problem is that during that delay period, all the participants in these different market sectors believe that they're going to get more of that new market share than they ultimately will. So what ultimately happens is oversupply is ordered. And as that supply starts to initially deliver, rates revert to normal. As the rest of that supply starts to deliver, rates tend to fall below that long-haul sort of value we refer to as intrinsic value and the rates that support intrinsic value.
So what's capacity utilization in shipping right now?
Well, right now, it's low. It's falling.
80%?
8.0?
Yeah, 8.0, yes. Coming from a peak of 90, well, close to 100% only 6 months ago.
Right.
And with many ships coming, new ships being delivered in the coming 1 year.
So what do we watch? We watch backlog. We watch for ships, for instance. The statistics in shipping are truly amazing. The bubble in the building of new ships was so great, it was driving a bubble in the building of new shipyards. Yeah. And so what basically happened was you saw these huge numbers of orders going on. Why? Because you saw huge rises in rates because people could not deliver enough capacity to China, could not deliver enough capacity to some of the other developing economies. So what has happened since? Well, early on it was mentioned, the Baltic Dry Index. If you go on Bloomberg and look at that, you'll just see a shocking picture. Rates have fallen by about 90%. As those rates have fallen by 90%, what is starting to follow on? What's following on is cancellation of orders, ships being laid up, all kinds of other things. So what does that do? It drives the pricing of shipping down. But this is happening in a lot of different sectors now. I mean, we're seeing another thing you can watch if you're interested in watching it. This is in progress. This is a process that is now occurring in the offshore world. You've seen Pride International. You've seen all of the drilling companies. If you look at their stock charts, another amazing thing that looks an awful lot like the Baltic Index. So what is happening? These are very long-lived assets that these industries own. They're in excellent condition. They're operated by experts. Their rates are falling. The values of their assets are falling. This, if you can position yourself against the risks of the operation of the asset, and if you can select the assets that have the longest life and the least technology risk, those assets will be long-haul, and our investment horizon is about 10 years. Long-haul, those are the greatest investments you can make. So that's what we see. We see an emerging opportunity here that we haven't seen since when we first started the business, our prior business at Citi 20 years ago.
Harry, you talked about the cash flow, and then you also talk about long operating agreements. Could you play devil's advocate for a second on either the tankers or the rail cars and just say, yes, but these contracts can be canceled or there's credit risk, and just really pick holes in the thesis so we can hear the other side and
Sure.
some of the risks.
Go ahead. Would you like to?
Well, I'll be, it's all about disclosing things. To me, risk is basically knowing the risk. If I pick on that very question on the creditworthiness, and I will throw names on the table here. I'm an ex-Dreyfus. I've been working 17 years with Dreyfus. And the joke was at the time in shipping is that the difference between a good counterparty and a bad counterparty is the bad counterparty when you have got this 5 years contract, one day you pick up the phone because you have not received the money and there's no answer. They've left. Or you call it in the US jingle mail, you get the keys back in the mail. The good counterparty is basically like a Dreyfus or a Cargill is, they ask you to come to the table and say, look, we are suffering. We just can't continue like that. So we need to renegotiate. So that's obviously a big danger because even the best counterparties, and we've seen that recently with a very big new iron ore mine called FMG in Australia, which on the paper looked perfect, maybe not AAA, but reasonably good rating. And within a few months of the market going down, they've defaulted on all their contracts. So that's obviously a big concern.
Same thing just happened to one of the drilling rigs on the highest day rate drilling contract in the world with a Filipino oil company, Philippine energy company. So the counterparty risk, I was a senior credit officer at Citigroup. That's kind of rare for a business head to also be a senior credit officer. Counterparty risk, structuring of the cash flow and operating agreement, who is responsible for operations and how they function, all key. Let me go to one other point, though. In our investment world, in an environment as we see today, you have operators or owners of assets. Sometimes they are also the operators, sometimes they are not. And you have the people who are using these assets. One way for us to enter a deal is the traditional way. We go in and we buy an asset or we buy a company that operates these assets, and we are looking at the creditworthiness of these operating agreements to the counterparties. Another way in this kind of environment where we can invest is to switch to the other side of the fence. We go to Shell, we go to an oil company, and we say, how much do you want to pay for how long? And we'll go try to find the people that we can buy to arrange that longer-term agreement. So we go back and forth across this fence looking for ways to make a deal happen that is strong enough to support our strategy. So in this particular scenario, it's a fairly distressed picture. But in fact, that's how we ended up with the steel plant. We actually there was an institutional investor that already owned it. It was a very attractive asset from our view, but it was a very broadly based auction. We don't really like auctions, so we were pretty conservative guys. We bid in this auction. There were 25 other investors. We came in 24th. So how did we win the deal? We went to the steel company and said, in fact, it was the quickest deal anyone ever awarded to us. In about 15 minutes, the vice chairman of U.S. Steel said, we will agree to restructure this deal with you if you will go buy the asset in. So there are lots of different ways for us to try to adjust down, in fact, in that case, the rates that people have to pay, and then they're willing to commit longer.
There's a trick you can use in shipping as well. If you go into a physical fixed price contract like 5 years, there's a strong incentive for your counterparty to default if the market drops. The way around that is to fix a floating price deal. So you just secure the capacity, performance from a good counterparty, but they have no incentive to default because it's a floating price. So whatever happens, they just pay market. And you staple with that physical floating price deal, a paper deal. And then, you do that paper deal on a clearinghouse, and therefore you face a lesser credit risk. So there are ways around these sort of things.
I guess from the skeptic's perspective, we hear all about the lack of credit in the world. And Harry, this is a capital-intensive business. Your business at Citi sounded like it was about 3 times levered. What is the optimal capital structure to exploit this today, and is that optimal capital structure available?
It's an interesting question. In an environment where we can see investments that will produce a 26-25% cash yield with no leverage or very little leverage, we have no incentive to raise that to a 50% IRR by levering it. Why? Because leverage is expensive. So just the native cash generation of some of these capital assets at this point is so high. And the other way you can test that is just look at what rates on debt is, and obviously the rate for equity is much higher. So we don't need a whole lot of leverage at this point to do these deals. That having been said, the same organization that we sold the $500 million portfolio for, other specialist organizations that Pierre would know in the shipping world, for properly structured transactions with the kinds of counterparties that we typically target and these kinds of entry levels, you can still get in today's market in the 60% sort of advance rate thing from typical bank players who have expertise in these assets. So in fact, this one institution, we were talking to them the other day about a distressed deal. They are in that deal already as debt. And we said, will you stay? And they said, not only will we stay, we'll increase our position. So when people talk about flight to quality, I think that in our experience it's been really two things. One is going to government sorts of things, but of course the returns are very low. The other is going to large corporate asset secured by core assets sorts of lending. So we have not yet seen anything that is a debt-driven limitation. Now, I will say there's another whole world of infrastructure. When you hear the word infrastructure, it's probably what you immediately think of. It's highways, it's ports, it's airports, things like that. That world is very much more debt-driven. And I would say I was talking to one of our friends in that sector a couple days ago, and I think that's where there is a significant limitation emerging for those guys.
When you take capacity out of rails or ships, what do? Just park them?
The answer is they just park them. Or one of the things we watch a lot is of course we're looking at backlog, we're looking at new pricing, we're also looking at age profile of that specific sector of the fleet and what's likely to be scrapped. So some stuff just gets laid up is the phrase, but other stuff eventually gets scrapped. It's an interesting dynamic. Again, shipping is a good example. People who have older ships want to keep those working because they've completely returned all their capital. So in a downturn like this, they tend to delay the scrappage process as long as possible because if those ships can stay employed, they throw off a lot of net cash. The problem is you come up to a limit called a special survey where every 5 years or so a vessel has to be put into a dry dock and has to be upgraded or repaired. The costs of that get higher and higher as the ship gets older. So eventually those ships get scrapped. And that's what you're seeing now. You were seeing years with zero scrappage in certain sectors, which is extremely rare and is an indicator of a market top to us. Now you're seeing the scrappage rates in some of those sectors rising.
When I'm selling 16 million cars or 17 million in 1 year and now down to 10 or 11, I don't know why that's not a disaster for rail car companies.
For the people who own them already, who are laying this stuff up, I mean, and I've been there before, that's how we started the business. We started buying defaulted rail companies. The answer is it's a real catastrophe for people who are already invested.
Right, but when I close a car plant, it closes and becomes a strip mall or something like that. When you close something, it just gets put on the side somewhere.
It's an interesting dynamic. Let's look at it from two sides. One's the supply into the plant, and one is the output of the plant. The output of the plant goes into specialized rail cars, generally speaking, that are called autorack cars. And it's a whole market unto itself. What's interesting about autoracks is the vast majority of them are controlled by one entity, trailer train. So from the perspective of the investor market, there aren't that many out there for people to own. It's mostly controlled by trailer train, which is controlled by the railroads themselves. So the people that own those things, are they seeing a lot of stuff stacked up? Absolutely. Is that impacting, a lot of investor community?
So it's a cartel.
That is, in fact, it operates under an exemption from antitrust laws. And I don't know if that exemption will hold up forever, but it's been around for a long time. I'll give you another example, though. On the housing side, it's maybe similar to what you're saying. There's a specialized rail car. It's very attractive to us because it meets all our criteria in terms of long, useful life and stable technology, all that sort of thing. Type of rail car, but all it carries is home building materials. It's called a center beam flat car. Carries drywall and lumber, that sort of thing. Right now, the utilization rate in the center beam flat car world is about 50%. We see that as glass half full. Why? Because we can go to the people who are still moving this stuff, the wirehousers and people like that, and say, how much do you want to pay to operate a car for 5 years or 3 years or 4 years? And with that knowledge in mind or with that data in hand, we can go look for distressed cars that they can now let other people's cars go and take ours in at a rate that is now helping them get back to a more normal cost base. Why? Because we can afford to do it. Our asset is acquired at a very low price.
Okay, I think this is fascinating. I've got a lot more questions, but I'd be happy to open it up. Jeff?
For Steve, with the bailout for the two car companies, clearly the priority number one is sustainability of the business, but second priority at some point must be returning to profitability. And I'm just curious to get your opinion on the subject of profitability and putting out better product, as you mentioned, with the price of crude well below 40, gasoline now by and large well below $2. Is returning to profitability just making better quality cars, or do you think that the car companies will truly embrace alternative fuel vehicles, or is that just going to go by the wayside? So far, profitability, please comment.
So, having just come back from Detroit, where everybody has electric everywhere, it's gone completely the other way. You can't go anywhere without electric. Chinese companies, everybody's got electric. The problem is nobody pays up for that, and does the consumer really want it? The issue, not to digress too much, but the issue in this country, in Japan they embraced hybrids because gasoline is a lot more expensive than it is here. In Europe they did with diesels, which get much better fuel economy. Here gas is very cheap, so what does the consumer want? The roads are wide, they want big trucks. SUVs, pickups, what have you. That's what the consumer wants. We have something, instead of a high price of gas, we have something called corporate average fuel economy, where basically the government forces the companies to instead of encouraging the consumer to buy and pay up for small cars, they are forcing the companies to sell a balanced fuel economy product. So if you're willing to pay up for a truck, and I make good money on that truck, in order to sell that truck, I got to force feed a small car into the market, and I lose money on every one. So that is one of the ways to solve this problem, is to tax gasoline and basically encourage the consumer to buy these fuel-efficient cars. 6 months ago, you talked to Toyota 6 months ago, a used Prius was going for the same price as a new Prius. There are Priuses all over the lot, they can't move any of them. So sustainability is one thing, and that's about getting your costs in line and your balance sheet fixed up. Profitability is another, and it's about balance. I need cars, and I need trucks, and I need the ability to make money on both of those. Right now in this country, it is very challenging to make money on cars, and I think they will have to offer this sort of alternative and they're all coming with this, whether it's plug-in hybrids or Ford's got a Fusion with 41 miles a gallon. They're all coming with this stuff. The question on profitability is whether the consumer is willing to pay up for this, and so far the answer has been no.
Question for Steve. You opened up your remarks talking about the global, the auto market is global, and I guess my 10-year sense that you were very Americentric in your discussion about GM, etc. Could you give me a flavor of your opinion of the management of the Japanese auto companies, Toyota, Honda, etc.? And from a demand point of view, given where the infrastructure is in certain countries, what's the demand look like for Latin America, Asia, and the Middle East?
Yeah.
We talked a lot about SARS. That's, I think, a U.S. practice in '69.
Right. So let me talk about the management of the Japanese companies. It's fascinating. So at Dana, which is a U.S.-based, 100-year-old U.S.-based supplier, one of the things we did for the CEO is we got the recently retired head of manufacturing for Toyota in this country, a guy named Gary Convis. We dropped him into Dana, and he's very much about culture change, very much about focus and leaning out a company and problem solving, what have you. And the challenge that we have with a sort of a Toyota manager in a U.S. situation is he wants to build bricks when there's fires going on all over the place where you need a fireman. And one of the interesting things, the interesting test in Japan right now will be, there's fires in Japan right now also. I don't know the exact SAR number in Japan, but demand in Japan has gotten very weak. Demand in Latin America had been holding up. That was sort of the last, I don't want to say the last domino to fall, but Latin America last month, I think, was down 20-25%. So that seems to be unraveling very quickly. I think what Japan has that we don't have is a balanced product portfolio. They know how to make money on small cars. They know how to operate companies in a resource-constrained environment. And there used to be the math that if you put our market on Japan's scale, it would be like us having something like 50 different car companies here. So they've been competing in a very resource-constrained environment for a long time. Honda's the perfect Honda doesn't pretend to be big. They don't pretend to be the best. They focus on powertrains and they focus on fuel economy. And they didn't play in the trucks. They didn't make the big money in the trucks, but they are well balanced in cars. And they do a lot of sharing of components around the world, much more sharing of components from one product to the next, much more sharing of components around the world, and that helps your cost and that helps your quality. So I think if I looked around the world, those companies, call it Toyota, Nissan, Honda, are still the best positioned companies around the world. That doesn't mean their stocks haven't been hit. They've been hit pretty hard, and especially with the yen at 90 makes it very difficult for them. But I view those management teams as the best, with Honda and Nissan in the short run, very good. Toyota has been building bricks for a long time, and I worry a little bit about their fixed cost structure.
A quick follow-on DC bailout discussions. Is there a myth that GM loses $2,000 to $3,000 a car because of health care and other pension compared to Toyota, Honda, et cetera?
So what happened was, as part of the 2007 negotiations, the union agreed to take all the retiree health care and move it into a trust. So they basically, if your liability was 100, they basically said, well, you fund it at 55 cents, and we will take retiree health care off your hands. That was the big give, the big, oh, wow, it started in 2005. It went, and so they cut it once in 2005. Then they cut it again in 2007. Now the government is making them cut it again, but it's really, it doesn't start till 2010. So 1/10 is the first big funding. One of the things I had to tell the union is, GM owes you $7 billion on January 1st, 2010 into this healthcare trust. I said you could restructure it now or you could restructure it later, but the fact is they don't have the money. If you look at operating, just competitive wages, Toyota this country versus GM this country, maybe about somewhere between $1 billion, $1.5 billion difference, and it's hard to measure this because Toyota does some things that are not contractual, so they're paying their workers in Texas not to work right now. Okay, Detroit would be criticized, that's a jobs bank, whatever, but Toyota's doing that, but it's not contractual, so they don't count. So a lot of this is apples and oranges, but even $1 billion, what's that? 30 days, 15 days cash burn at GM right now? That's why people think it's about union and management, and it's not. People think it's about North America, and it's not, because they are bleeding cash almost everywhere in the world right now. This has become a global problem. Labor's only 10 or 12% of the cost of the car. So in Japan, Japanese here, maybe it's 8, but it's not going to change. It's not going to change the whole equation. Oh, it's a revenue. Listen, the Honda Civic gets probably $2,000 more in revenue than the Chevy Malibu. It's a revenue issue.
Bob, Steve, with Cerberus and their involvement with Chrysler, they were somewhat vilified in the press, and you expressed a need for the industry to have capital. How are groups that you know and yourself viewing that opportunity? Because if it goes against you and you don't put up more money, it seems like you're a $1 billion fund and you won't put money in. And if you make a ton of money, it seems like you might be vilified for making money on the backs of workers. And so how are they?
So let's be clear. Private capital in the car. One of the problems with the cyclical business is you got companies with high operating leverage, and if you put a lot of financial leverage on this, it's combustible. There are points in the cycle every time where it will be a monumental home run. I think Cypress had a monumental home run with Lee or something in the early 90s or early 2000s. You've had some monumental home runs, but it could also be a monumental disaster. So when we took Dane out, we put a lot of cash, made sure there was a lot of cash on the balance sheet to survive the perfect storm that's about to hit. Cerberus, I think that's sort of I don't want to say it's a special case, but there was a lot of financial engineering in there that is sort of raising eyebrows. So typically you have a company the credit company has historically been owned by the auto company. They took Chrysler, they separated the credit company out from the auto company. Most of the value was in the credit company. They put $9 billion of debt on the auto company, where they had really very little investment in there. Most of their investment is in the credit side, and it created this sort of perceived conflict between the two. All we care about is a credit company. We don't care much about the auto company. We got workers, suppliers, dealers that are sort of hanging by a thread on this thing. I'm saying perceived conflict because I don't know if it's there, but that's where I think there's a lot of criticism that you sort of loaded the auto company up with debt and now you want to throw the keys back on the table, so to speak. So how it resolves itself, time will tell. Maybe the cars will.
I'm glad you prompted me. What do you think of the idea of a czar in the United States? Yeah. and for me, it connotes central planning.
Yeah, the czar. word czar is quite fascinating, right? So it's, why they call it a czar. I guess I think two things. One, the government's going to put a bunch of money in here. Somebody needs to look after this and make sure we're not flushing money away. Second, those of you know bankruptcy, you probably know a lot better than me, but bankruptcy is a big food fight. And you got a lot of people in the room, and the worry is if GM goes into bankruptcy for an extended period of time, you may as well forget about GM. So somebody's going to need to be there to sort of moderate this food fight or mediate this food fight that is bankruptcy. Or it may not be maybe an out-of-court bankruptcy to get them in and get them out quickly, or get them restructured in an efficient manner. It's basically going to be a thankless job because every constituent's going to have to come to the party, and you're going to have to basically take arrows from every constituent. But I think it's something, whether it's one person or whether it's a group of people, I don't know, but it's something that's going to have to be done.
Thank you. I think there's time for one more question. Jimmy.
Could each of you discuss the investment horizon and liquidity in your markets?
Sure. Our investment horizon runs from about 4 years to about 10. It's driven in part by cycle and other sorts of drivers like that, but we would have a typical hold position about that long. Liquidity, interestingly, in the business, in the kinds of investments we make, there are lots of components of value in a particular investment. Some are different from others. Those can be the cash flows that they generate. They can be rights associated with it, options that can be written or bought in. The assets themselves and how they get traded. There's an institutional investor community where there's secondary trading of these kinds of established, fully rigged investments. The liquidity is actually pretty good. We would often, in fact, on an annual basis, take pieces of our portfolio and float them into the market to see what people's interest levels were. And we always had lots of people who were interested in trying to take them. That's not to say that the pricing is always that attractive, but the fact is that these assets are pretty liquid.
Well, if I look at the hedge fund I'm managing now, basically the time horizon is just a month to 2 or 3 months, because we're a monthly liquidity, and because of the nature of the short-term cycles and the volatility of the market, that's what is applicable. If we talk about special opportunities, which is investing in hard assets or actually buying companies or buying portfolios of distressed loans or something like that, I think you need to look at anything between 3 to 10 years. And the liquidity is very small. We are a very interesting industry in the sense that we're at the core of the world economy. You've heard about these pirates, of the Somali coast. Just to give you an idea, the total fleet of what we call VLCCs, very large crude carriers, the world fleet is only 500 ships. Okay, you guys in the U.S., you basically import 50% of your oil. Okay, so if you take away a few of these ships, then we all have a problem. It's very, very, very small industry. In bad times, you may have only a few percent of the fleet which is going to change hand. In the crazy days of mid-2008, you may have had 30% of the fleet changing hand. So it's a very, very small industry. It's critical for the world economy, but it's very, 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 very small. So, you can be caught with assets that you can't get rid of. But I would say, time horizon on the special opportunity side, if you want to play distress, is 3 to 10 years. And you need to know that it's a very, very small industry.
I guess we've heard a lot about consolidation and pain and tightening the belts, and hopefully that will create a more rational and a tighter supply for us all. Appreciate the speakers' comments very much, and I'm going to hand back to Steve for some housekeeping.
Thanks, Ryan. Thanks very much. While I'm talking, if you would fill out your report cards. The programming committee's meeting right after we get done talking, and if you could have your suggestions for our topics in 2009 that we can look at for the committee, that'd be great. And the programming committee will meet right in this room. Tony, if you can get them to start setting up now so that we're not hanging out waiting for the tables to break up. A fellow sitting to my right, if you don't know him already, is Michael Castine. You should know him. Michael's been a fellow of the Roundtable for many, many years. You all are connoisseurs of good moneymakers. Well, Michael's a connoisseur of a good LP. And he has the investment management practice at Korn Ferry. And Mike, would you like to say anything to the gang?
Sure. I resemble those remarks, Steve. Thank you. We're honored to be hosting today, and what a great discussion with Pierre, Steve, and Harry, and a very timely topic. And just to follow up what Steve said on a professional front, I think many of you know us from working with either industrial companies or traditional investment firms, financial institutions, private equity firms, clearly the hedge funds and alternatives, and family offices. On a personal front, as Steve said, I've been affiliated with the Roundtable since the mid-'90s, and that's because of my investments in limited partnerships. However, I was just doing some math while we were sitting here, and I think my partnerships were worth a lot more back in the mid-'90s than they are today. But anyway, Harry said good news is on the horizon. So other good news is despite these markets, we've actually been fairly busy in the investment space in specific pockets. So hang in there. It's coming. Thank you very much. We're honored to be here.
Thanks very much, Michael. And we'll meet here next time on February 17th. The topic is Psychology in the Markets After the Fall. Richard Zeckhauser from Harvard and Jason Zweig from the Wall Street Journal will join us. But again, I want to thank Ryan, you for your leadership, and you put together some terrific panels. Harry, Pierre, Steve, very good job. Thank you.